This is your Swap Hunt Daily News for February 28, 2026. U.S. and Israeli military strikes on Iran triggered a crypto-wide panic sell-off today, while Wall Street's biggest banks are quietly building Bitcoin infrastructure. Markets are firmly in bearish territory today, with the Fear and Greed Index sitting at extreme fear. A coordinated U.S. and Israeli military strike on Iran triggered a sharp sell-off across all major crypto assets over the weekend, with total market cap shedding over $100 billion in hours. Bitcoin pulled back sharply before stabilizing, while altcoins took even heavier hits. The regime remains bearish, with price trading below its 20-day moving average. Traditional markets were closed when the strikes occurred, meaning crypto absorbed the full impact alone. Coordinated U.S. and Israeli military strikes on Iran have triggered the largest single-day panic sell-off in crypto markets this year. Bitcoin plummeted from around 66,000 to a low of 63,000 within hours of the news breaking before partially recovering. The strikes targeted Iran's missile systems, naval assets, and nuclear infrastructure, catching markets completely off guard. Because traditional stock markets were closed for the weekend, cryptocurrencies bore the full brunt of the shock. There was no equity market to absorb or contextualize the fear, so crypto became the only liquid risk asset available to sell. The human cost in market terms was significant. Over 152,000 traders were liquidated in the aftermath. CoinGlass data showed roughly $192 million in Bitcoin futures alone were wiped out, with trading volume surging sharply as derivatives amplified the move beyond what spot sellers alone could have driven. Total liquidations across all crypto assets hit over $500 million within 24 hours. Ethereum dipped below 1,850, XRP slumped hard. Solana, Cardano, Dogecoin, and Chainlink each gave back between 8 and 12% of their value. The Fear and Greed Index fell deep into fear territory at 14. This is what a genuine macro shock looks like for crypto markets: fast, indiscriminate, and amplified by leverage. Even as markets were being hammered by geopolitical shock, two of Wall Street's most prominent institutions quietly announced sweeping expansions into Bitcoin and crypto. Citibank and Morgan Stanley both moved to broaden their crypto infrastructure, covering custody, trading, and tokenization services. Citi is integrating Bitcoin directly into its bank-level custody and reporting systems. Speaking at the Strategy World Conference in Las Vegas, Citi's head of digital asset custody development described the bank's approach as making Bitcoin bankable, building wallet infrastructure, key management systems, and a single service model that allows institutional clients to hold BTC alongside traditional assets within existing compliance and tax workflows. This is not a test product. This is Citi extending its $30 trillion traditional asset framework to include digital currencies. Morgan Stanley's push is equally significant. The bank is expanding crypto trading for high-net-worth clients, exploring lending services backed by Bitcoin, and developing tokenized products. It has also filed with the OCC for a bank charter specifically to custody crypto assets like Bitcoin, Ether, and Solana. If approved, Morgan Stanley would become a federally chartered crypto custodian, the same milestone Crypto.com achieved last week. Together, these moves represent a structural shift. When banks at this scale build the plumbing, they're not speculating. They're preparing for sustained institutional demand. Senate Democrats are turning up the heat on Binance. 11 members of the Senate Banking Committee, led by Elizabeth Warren, sent a formal letter to the Department of Justice requesting a fresh investigation into the exchange. The inquiry centers on recent media reports alleging Binance facilitated transactions linked to Iran, potentially violating the terms of its 2023 settlement with U.S. authorities, the agreement that resulted in founder Changpeng Zhao's resignation as CEO and a significant fine. Warren's letter was also directed at Treasury Secretary Scott Bessent, urging coordinated scrutiny of Binance's operations. The specific concern is whether the exchange has continued to handle transactions tied to Iran despite its compliance commitments. Earlier work by Senator Richard Blumenthal's Permanent Subcommittee on Investigations had already raised flags about roughly $1.7 billion in alleged sanctions violations flowing through the platform. Binance pushed back, saying an internal review found no evidence of sanctions law violations, but that defense carries less weight when it comes from the subject of the investigation rather than an independent auditor. For Binance, this is the latest chapter in an ongoing battle for regulatory legitimacy. For the broader market, it adds regulatory uncertainty at a moment when institutional players are closely watching how major exchanges handle compliance. Tether has frozen approximately $4.2 billion worth of USDT tokens linked to suspected criminal activity since 2023, with nearly half of that total frozen in just the first 3 months of 2025 alone. The stablecoin issuer worked with law enforcement agencies, including the Department of Justice, the Secret Service, and Thai police to block funds tied to pig butchering scams, terror financing, money laundering operations, and other fraud schemes. CEO Paulo Arduino has been vocal about the company's cooperation with authorities, framing USDT as a transparent tool against financial crime. The actions included helping freeze $61 million tied to pig butchering scams in a single operation last May, $6.2 million in a Brazilian money laundering case, and over $100 million connected to a wider fraud scheme. What makes this notable is the scale. $4.2 billion is not a rounding error. It represents a meaningful enforcement capability that stablecoin issuers have quietly developed, one that regulators are increasingly counting on. For Tether specifically, this data serves a dual purpose. It demonstrates regulatory goodwill at a time when stablecoin legislation is being actively debated, and it counters the persistent narrative that USDT is a tool for avoiding oversight rather than enabling it. Vitalik Buterin has unveiled a new strategy to tackle Ethereum's long-standing scaling problem, and it marks a notable shift in emphasis. For years, Ethereum's scaling roadmap has been built largely around Layer 2 rollups, off-chain solutions that process transactions separately and then post proofs back to the main chain. Buterin's new plan puts renewed focus on the base layer itself. The details are still emerging, but the significance is in the signal. When Ethereum's co-founder publicly pivots his attention from Layer 2 infrastructure back toward the core protocol, it tells you something about where he sees the ceiling. Layer 2 solutions have delivered real scaling improvements, but they come with trade-offs: centralization risks in sequencer design, throughput constraints, and fragmented liquidity across dozens of competing rollup ecosystems. A base layer solution, if implemented carefully, could address these structural limitations without the fragmentation problem. This announcement comes at a particularly sensitive moment for Ethereum. The asset has underperformed significantly in the current cycle, and institutional participants have been pulling back from ETH ETFs. Buterin putting his focus back on core infrastructure won't reverse that in the short term, but it matters for the longer-term investment thesis. Ethereum's value is tied to its utility. A credible scaling solution from the protocol's founder is exactly the kind of development the network needs. Amid the market panic triggered by geopolitical events, Bitcoin's derivatives market is flashing a contrarian signal. Funding rates in Bitcoin perpetual futures have plunged to -6%, a level that historically sets the stage for a short squeeze. When funding rates go deeply negative, it means short sellers are paying long holders to maintain their positions. The more extreme the negative reading, the more overcrowded the short side becomes. At some point, that crowding becomes self-reinforcing in the other direction. As the price begins to recover, shorts get squeezed out, adding upward buying pressure. This dynamic has preceded sharp countertrend moves in previous cycles. It doesn't tell you when or how far, but it does suggest the market is heavily positioned in one direction. That asymmetry is exactly what traders hunting for a squeeze look for. Layered on top of this, Bitcoin mega holders, wallets with at least 100 BTC, have been growing in number toward 20,000 according to sentiment data. That suggests broader distribution rather than concentration, which can reduce the influence of any single large seller. And separately, commitment of traders data flagged by analyst Tom McClellan shows non-commercial futures traders moving net long with what he described as some urgency. 3 independent signals, all pointing in the same direction on a day when the headline price action looked entirely bearish. That's your daily crypto roundup for February 28th. If you found this useful, subscribe to Swap Hunt HQ here on YouTube and follow Swap Hunt on X for real-time market alerts. See you tomorrow.